So let us see the conceptual framework or for financial reporting. So organizations, private entities, as well as non-private entities, when they are registered as companies under the Companies Act, they must produce financial statements based on the conceptual framework for financial reporting. Okay, so we need to understand what is the conceptual framework for financial reporting. The conceptual framework establishes the concepts that form the basis of financial reporting. Okay, so the framework specifies the concepts that organizations should follow when they produce their financial statements. Okay, so the conceptual framework has laid down the objectives of financial reporting. It lays down the qualitative characteristics of useful information. So when organizations produce information inside their financial statements, they must make sure that these information would satisfy the qualitative characteristics that has been laid out by the conceptual framework. And then the conceptual framework also spells out the financial statement elements. What are the elements that should be included in financial statements? And then the conceptual framework also talks about the recognition, the measurement principles, and how to, in terms of presentation and the disclosure of the financial statements. According to the conceptual framework, the objective of financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Okay, so financial reports should provide financial information. What would be the information about? The financial information should be about the reporting entity, the company itself, and that information should be useful to whom? It should be useful to investors, lenders, and other creditors, whether they are existing investors, lenders, or creditors, or if they are potential investors, lenders, and creditors. Okay, and what would that information be useful for? It will be used by these people in making decisions. And what sort of decisions? The decisions will be about providing whether or not they want to provide, to what extent do they want to provide resources to the entity. Okay, so more specifically, the decisions that they will be making will be about whether they want to buy or sell or hold equity and debt instruments of the entity. So whether they want to buy shares or sell off the shares of the company. Secondly, whether they want to provide or settle loans and other forms of credit. So lenders would like to know whether they should be they would give out loans to the company. And thirdly is to exercise rights to vote on or otherwise influence management action that affect the use of the entity's economic resources. So potential investors would like to know information so that they will make decisions, or they will vote during the annual general meeting. And information that is provided in the financial report should allow users to assess the future net cash inflows of the entity and the management stewardship of the entity's economic resources. So two things there. The information should be able to be used by the users to assess the future net cash inflows of the entity. Okay, so by looking at the financial report, the users should be able to estimate whether the company is able to gain cash inflow in the future. And secondly, the information inside the financial report should be able to be used by the user when they want to assess whether the management of company is is doing well in managing the company. So just a repetition from the previous slide, that the main users of financial reporting will be the investors, the lenders, and other creditors. Okay, so if you notice, all of these people are outside of the organization. They are the investors, they are the lenders, they are other creditors. These people are outside of the management of the company. They are not employees of the company. They are not management of the company, because financial reports, like I said in the very first lecture, financial reports are within the financial accounting area, and financial accounting is mainly to provide information that will be used by people outside of the organization. For information that will be used by people inside the organization, that will be within the management accounting. Okay, it will be management accounting information, but we are talking about the financial accounting information, which is used by people outside of the company, including the investors, lenders, and other creditors. The conceptual framework for financial reporting has laid down the qualitative characteristics of useful information. The conceptual framework has laid down two types, okay, two main categorization of characteristics. Firstly is the fundamental characteristics, and secondly is the enhancing characteristics. Okay, so fundamental characteristics are the must-have characteristics, or the obligatory characteristics that financial statements should have to ensure that the information is useful. Whereas the enhancing characteristics are not obligatory, but they, however, when information has these enhancing characteristics, it will add value to the usefulness of that information. So all of the information that is provided in the financial statements must have the fundamental characteristics, but may have to certain extent some of the enhancing characteristics. So we will see what are the fundamental characteristics and what are the enhancing characteristics that organizations should try to follow. The first fundamental characteristics is relevance. Okay, so relevant, what is meant by relevance? Relevant information is capable of making a difference in the decision made by users. Okay, so a relevant information is that when that information is conveyed to the decision to the user may make a different decision based on that information. So if that information is presented, they will make a different decision as compared to if they are not presented with the information. Therefore, that information is considered as the characteristics of that information is considered as relevant. Okay, so in order for the information to be relevant, it must have the sub-characteristic, the three sub-characteristics. Firstly is predictive. Okay, what is meant by predictive? The information can be used as an input to processes employed by users to predict future outcomes, meaning that when that information can be used by the users when they want to predict what will happen in the future, that information is considered as predictive, which is one of the essentials of being relevant. Secondly is the confirmatory. Confirmatory means it provides feedback whether it confirms or changes previous evaluations. Okay, so when users have seen financial statements and they see a new information, and that information confirms what they have seen before, or it changes what they have seen before, then that is called confirmatory. That information is confirmatory, therefore it has the relevance characteristics. The third sub-characteristics of relevance is materiality. Materiality either in nature or materiality in terms of magnitude or in terms of dollars. What is meant by materiality? If an information is omitted or misstated, it could influence decisions that the primary users make based on that information. So if an information is not included in the financial statement, or if that information is wrong, that would influence how users make decisions, then that information is considered as material. Okay. However, if there are some information that whether or not that information is disclosed has no impact on how users make decisions, then therefore that information is not considered as material. So in order for an information to be relevant, it must either have predictive value or confirmatory value, and it must also have materiality value in order for it to be relevant. The second fundamental characteristics is faithful representation. Okay, so faithful representation meaning that the information conveys the true position, the true performance of the company. So in order for information to be a faithful representation of what it shows, firstly it should be complete. Okay, information should be complete. It includes all information necessary for a user to understand the phenomenon. So all information includes the numeric information, okay, the numbers, as well as the description, okay, the wording, okay, the title of the items. Secondly, the information must be neutral. The information is not slanted, it's not weighted, it's not emphasized or de-emphasized, or otherwise manipulated to increase the probability that the financial information will be received favorably or unfavorably by users. What does that mean? When information of the company is slanted, is given weightage, is given emphasis in order to influence how users perceive the financial position, okay, then that is considered as non-neutral. Okay, information should be neutral. Okay, so the users should be able to assess the performance of the organization in a neutral way. The information should not somehow be a biased information that tries to change the perception of the user on the performance of the company. Okay, it should show objectively. So that is meant by neutral. Third, information should be free from error. There are no errors in the description of the phenomenon. There are no errors or omission, and the process used to produce the reported information has been selected and applied with no errors. Firstly, there is no errors or omission in the description of the events, and then the process of producing the information also is free from error. We use a very systematic, error-free process in producing information. Okay, that is meant by free from error. So all these three sub-characteristics are required in order for us to present a faithful representation information regarding the performance and the financial position of the company. So these two are the fundamental characteristics. And when we want to apply the fundamental qualitative characteristics, firstly we need to identify the economic phenomenon, the economic events of the company, information about which is potentially useful. Okay, we need to identify the economic phenomenon where the information of that phenomenon will potentially be useful. And secondly, we identify the information about the phenomenon that would be relevant. Thirdly, we determine if the information is available and can provide a faithful representation. Okay, the other characteristics, qualitative characteristics, that will be enhancing the value of the information. Firstly, is the comparability. What is meant by comparability? Comparable information is that when the differences and similarity among items can be shown through that information. Okay, when different items, when it is represented, the users will be able to compare and contrast between those items. Okay, that is comparability. Secondly is verifiability. The verifiability is that when that information is given to knowledgeable and independent observers or people, they would come to the same conclusion. Okay, so the same information given to two or more people, the two or more people will come to the same conclusion. That means the information is verifiable. However, if the same information is given to several people and they would conclude differently, they will think of the company differently based on the same information, that means the information is not verifiable. Thirdly is the timeliness. Okay, having information available to decision makers in time to be capable of influencing their decisions. Okay, so information, for an information to be more useful, it needs to come at a time that it is able to be used by the decision makers. Okay, if the information is too late, therefore it is not timely, and therefore the usefulness of that information reduces. The fourth characteristic is the understandability. Okay, understandability is the classifying, characterizing, and presenting information that is clearly presented and concisely presented. So information needs to be classified, needs to be characterized, needs to be presented in a clear and concise manner. So when we apply all of the four characteristics, we are enhancing the value of information. However, to apply the enhancing characteristics, we try to maximize to the extent possible, meaning that although we have four characteristics, sometimes we cannot fulfill all of the four. We try to maximize as much as we can, and we maximize it through an iterative process. Okay, for example, when we prepare our financial statements, we try to make it comparable, although it is not exactly timely, but then later on we try to improve the timeliness and probably sacrifice a little bit of the comparability and the verifiability. Okay, so it is an iterative process. We try to get the maximum benefit out of these characteristics in a certain way. Okay, not all of them can be satisfied 100% at the same time. Okay, and in order for us to choose or prioritize which of these characteristics, we need to take into account the cost constraint, okay, which is considering between the cost and benefit. Because for us to improve on these characteristics, it will incur cost on the preparer of the information and cost on the users of information. So we need to compare the cost and the benefit that the users will get out of that information. So balancing the cost and benefit in order for us to decide to what extent do we want to have these characteristics.